Foreign exchange rates. Foreign exchange is the exchange of one currency for another, or the conversion of one currency into another currency. Foreign exchange rates are relative and expressed as the comparison of the currencies of two countries. The foreign exchange market is the largest and most liquid market in the world. Over $5 billion is exchanged daily. The largest trading centers are located in London, New York, Singapore, and Tokyo. The most actively traded currencies are the US dollar, the euro, the British pound, the Japanese yen, and the Canadian dollar. Factors that influence exchange rates are differentials in inflation, differentials in interest rates, current account deficits, public debt, terms of trade, and political stability and economic performance. Differentials in inflation means the currency that has the higher inflation rate will depreciate relative to the currency with a lower inflation rate. Countries with lower inflation rates exhibit rising currency values. This means that if the inflation rate is lower in the United States, there will be a greater price increase on goods imported from the foreign country than on domestically produced goods. If a foreign country has an inflation rate of 8% and the United States has an inflation rate of 5%, the inflation differential equals 3%. Differentials in interest rates. An interest rate differential is a difference in interest rates between two currencies. The higher interest rates offer lenders a higher return. Lower interest rates decrease exchange rates. If someone earns interest on a domestic savings account at 6% and then takes a loan from a foreign bank with a 4% interest rate, the person can put the borrowed money in their savings account with a 6% interest and earn a 2% profit. Current account deficits. This reflects payments between countries for goods, services, interest, and dividends. A deficit shows the country is spending more than it is earning on foreign trade. This means they may need to borrow capital from foreign sources. It requires more foreign currency than it receives through the sales of exports. Excess demand for foreign currency lowers a country's exchange rate. Public debt is one factor influencing exchange rates. The debt rating is a vital determinant of exchange rates. For example, to pay for public sector projects, countries engage in large-scale deficit financing. Countries may print money to pay off the debt, which causes inflation. High inflation makes investing from foreigners unattractive. A higher inflation means that the debt is eventually paid off with a cheaper future dollar. Terms of trade is another factor influencing exchange rates. Terms of trade is the ratio comparing export prices to import prices. If a country's exports rise more than imports, terms of trade improve. Increasing terms of trade shows greater demand of a country's exports. This results in more revenue from exports. It increases demand for the country's currency, and it increases the currency's value. Political stability and economic performance influences exchange rates because foreign investors want to invest in stable countries with strong economic performance. A country with positive performance draws investment funds away from less stable governments. Political turmoil can cause loss of confidence, which causes movement of capital to other currencies, as is the case in Greece and Syria. Another thing to think about is what the 2017 United States elections might do to influence foreign exchange rates. Spot rates and the spot market. Spot rates are the price to exchange one currency for another for immediate or earliest value date. The settlement date or value date for most spot transactions is 2 business days, except for United States and Canada transactions, which is the next business day. The price is established on the trade date, and then money is exchanged on the value date or settlement date. This can mean that there is credit risk between the two parties. The spot market is where spot trading is done. It's called the Forex market. This is where currencies are traded electronically from around the world. The spot market can be very volatile. It's made up of short-term and long-term rates. Short-term rates are driven by technical training, which focus mainly on direction and speed of movement. They can be based on rumor and speculation. Long-term rates are driven by fundamental factors, such as relative interest rate and economic growth. A country's central bank can intervene to smooth out the market. They do this by buying and selling local currency or by adjusting interest rates. Cross rates, major crosses, and minor crosses. The technical definition of cross rates is the currency exchange rates between two currencies when neither are official currencies of the country in which the exchange rate quote is given. More commonly, traders use this term to refer to the currency quotes that do not involve the United States dollar, no matter what the country the quote is given in. Major crosses are the most actively traded pairs of currencies quoted against each other in the Forex. These include the euro versus the Swiss franc, the euro versus the British pound, the euro versus the Japanese yen, and the British pound versus the Japanese yen. The euro is the base currency if it is included in the pair. The British pound is the backup base currency if it is included in the pair. Minor crosses are less actively traded than major crosses. These include the Swiss franc versus the yen and the British pound versus the Swiss franc. Japanese yen are usually the base regardless of the other currency. What is foreign exchange risk? Who does it affect, and what are the types? Foreign exchange risk is the financial risk of an investment's value changing due to the changes in currency exchange rates. It's also the risk an investor faces when he needs to close out a long or short position in a foreign currency at a loss due to an adverse movement in exchange rates. This can also be called FX risk, currency risk, and exchange rate risk. Foreign exchange risk affects businesses that export and or import their products, services, and supplies. It also affects investors making international investments. For example, if money needs to be converted to another currency to make an investment, changes in the exchange rate will cause the investment's value to decrease or increase when the investment is sold and then converted back to the original currency. There are 4 types of foreign exchange risk. The first is transaction exposure. This is the risk faced by companies involved in international trade. Currency exchange rates change after the companies have already entered into financial obligations with other companies. Exposure to fluctuating exchange rates can lead to major losses for firms. Companies use forward rates to lock in an exchange rate and eliminate this risk. Another risk is economic exposure. A firm's market value is impacted by unexpected currency rate volatility. An example is if a supplier is located in another country and that firm's currency is suddenly strengthened against the supplier's currency, it can positively affect cash flow and value. This means it can be managed strategically through arbitrage and outsourcing. Translation exposure is another type of foreign exchange risk. When financials are prepared for another country, they must be translated into that country's currency. This may not affect the firm's actual cash flow, but it could affect reported earnings, which affects the stock price. The last foreign exchange risk is contingent exposure. This is when firms bid on foreign projects and they negotiate contracts directly with the foreign firm. Because currency rates can fluctuate, the firm won't know the status of their currency in contrast with a foreign currency until the bid is accepted. This concludes my presentation on foreign exchange rates. Thank you for listening.